What's up, everybody? Welcome back to the Commercial Real Estate Playbook. It is Sita Mbuya, capital markets advisor and commercial real estate consultant. I own a couple hundred apartment units, and in today's video, I'm going to break down whether investors should use syndication for the next deal or if they should go with institutional equity. Of course, there's a lot of different ways to be able to raise capital for your commercial real estate project or your apartment complex acquisition, but in this video, I'm going to break down two primary ways that people raise capital. And this one, I'm going to talk about what each one of them is. Syndication, I'm going to break down what syndication is. I'm going to break down what institutional equity, what that means, at least in the general sense. And then I'm going to go over the pros and cons of each and when you should use one versus the other. All right, so first, what is syndication? So syndication is just a fancy word for a group. So this is when you're investing in real estate as a group of people. Typically, there's going to be two different sides. You're going to have the general partnership, you're going to have the limited partnership. And I'm going to start with the general partners. So the general partners, if you're watching this video, that's probably you. You're an operator, you're a sponsor. Those are other words for general partner. But basically, you're the person that's controlling the deal. You're going to be the active investor. So you're going to source the deal. You are going to do the due diligence. You're going to put up the capital up front, your earnest money. You're going to actually do the asset management, hire the property manager, decide when you're going to exit. So you're basically doing all of the work as a GP. And with you doing all the work, you also have all the liability. So if anything goes wrong and you end up getting sued, as a general partner, you face some level of liability. Of course, you can have insurance and you have, some layers of protection, but essentially you are the active investor. You're making all the decisions of what happens. So you could be held liable depending on what goes wrong. Now, the limited partnership, these are going to be your passive investors. So LPs, limited partners, they're just the people who put their money up. So they don't have any say in how the deal is structured. They don't have any say in how you acquire the deal, how you source the deal, how the property is operated, the team you put in place. They don't do anything. And because of that, they also have no liability. Even if something went wrong, the general partnership could be at fault in a lawsuit. The limited partnership is absolved of all of that because they're not making the day-to-day decisions. So just remember that GP is active investor, LP is passive investor. Now, how this typically works in a GP LP syndication, you are going to go to what is called retail investors. So these are going to be usually like high net worth or professionals that make a decent amount of income, whether it's a 506B or 506C. If it's accredited investors only, or if you can also have sophisticated investors. But basically, these are going to be people that are just standard individuals, and they're going to be investing typically around 50 to 100,000. Sometimes you may go as low as 25K. Sometimes they may want to put in more, but that's generally how it's going to go down. For example, on our last acquisition, we raised 2.3 million in a syndication. It was a 506B syndication, so we had both sophisticated and accredited investors. And in that, we raised 2.3 million across 43 different retail investors. So 43 different people gave in ranges of some as low as 10,000. A couple of people gave as low as 10,000. Most were around 50,000, and one investor gave over 300,000. So you have a range of people, a lot of different investors, and you got to manage all these different investors, communicate with all these different investors to get this deal done. Another benefit is that your risk is spread out. So because you have several different investors, like I mentioned, 43 different investors for our last syndication, when you have that many different investors, if one investor pulls out, then you still have all these other investors. It's a little easier to replace one investor that pulls out last minute when you need your equity to be able to fund a deal. So by diversifying your risk among a lot of different investors, it's just a little easier in case something goes left. And then lastly, you get more control over the deal itself. When you're working with retail investors, again, like I said, they don't have any say so in how things are operated. They just put their money up. So with you being the general partner, you're making all the decisions. So throughout the course of the life cycle of the project, you're making decisions yourself. You don't necessarily have to have your investors breathing down your neck. Of course, you are responsible to them. You have a obligation to do right by them and be a good steward of capital, but you just have more autonomy in how you make decisions. All right, the cons of syndication. So as I mentioned, you're raising money from a lot of different people. So if you're raising money from a lot of different people, that's a lot more conversations you need to have on an ongoing basis. You essentially have to build an entire kind of marketing structure or marketing platform outside of just doing the real estate. That's one of the things when it comes to commercial real estate. I say this all the time that commercial real estate, when you get to that level, you're dealing with that volume, you will spend just as much time figuring out how to finance your deals as you do actually doing the deals. The fundraising and the securing of capital becomes an entire full-time job, so much so a lot of firms will dedicate a role or somebody on the team to focus on funding. So there's going to be a lot of marketing, whether it's through LinkedIn, YouTube, other social media platforms. If you have an email newsletter, it's going to take a lot of investor calls. You need a CRM. You're going to have to do a lot of marketing to different investors because if there's always going to be some kind of ratio, like 10 to 1 maybe. So if you have like 1,000 different investors in your database, only 10% may invest on a given deal. So you're going to have a constant churn of keeping investors in the loop, and then being able to share deals with them, keep them interested, and making sure that they want to invest in your deal. But that in itself becomes a full-time job. That's not only during the acquisition or when you're raising capital, but even beyond when you actually acquire the deal and you're operating. That's a whole bunch of different investors that may have questions about how the deal is doing. Typically, if as long as things are going smoothly and you have a good system for giving them regular updates and communicating well, they typically won't have too many questions, but you're still held liable. They can reach out to you at any time and just kind of ask how the deal is going. So that's a lot of people that you need to communicate with on an ongoing basis. So that just investor management becomes a whole piece, a whole part of the business that you got to think about with syndication. Another con is going to be the education aspect. So a lot of investors, like I mentioned, they're retail. Some of them professionals, they're going to be, some of them are doctors, lawyers, engineers, other business owners. So people are in different fields, and the reason they're investing with you is because they want to be passive. They do not want to deal or be experts in real estate. They want to know enough to be able to know who to invest with, but they don't want to necessarily be experts in real estate. And especially if it's like their first time investing, they may not be as sophisticated. So a lot of your content or your marketing strategy is going to involve educating them, getting them up to speed on what the asset is, overall how to invest, what to look out for. So there's a lot more hand holding when you're dealing with syndication, especially if you're dealing with some new investors. Another thing when dealing with new investors is them just sometimes not being patient or understanding how things work. You got to be able to manage distribution across a whole bunch of different investors. And if things aren't necessarily going as well in the beginning, especially if you're doing a value add and the value add portion, the stabilization period just isn't moving as quick. Some investors, especially if they're newer, may get antsy about, they invested $50,000 or $100,000 and they're just expecting distributions. They're expecting a return on their money. And if it doesn't come quick enough, they just might get a little more antsy because they just aren't as familiar or they're a little more anxious about the investment. So just something to think about. That's one of the cons is that you're having to deal with and handhold your investor base when you're doing the syndication. So institutional capital, on the other hand, is when you're going to get the bulk of your equity from one large investment firm. It's typically going to be like a private equity firm. It may be a family office or even a life insurance company. But instead of you raising all of your money from several different investors, you're going to raise like 90% of your equity, which is standards. Typically 90% of equity is going to come from one large check writer, one of these firms that I just mentioned. And institutional firms, they're a lot more sophisticated. These are professional investors. They essentially do what you would do on the syndication side, but that's all they do. They typically will spend all their time raising capital from different sources. Sometimes it's individuals, sometimes it's other firms, but they put together capital. Sometimes it may be a fund, it may be a fund of funds, but they have a whole bunch of capital and their job is to deploy. They typically do not operate real estate. They just deploy capital or do what they call capital placement. They'll place capital into other operators' deals, and then that operator is going to do all the work of actually operating or developing, doing acquisition, everything. So they take the place of that entire arm of your business that's going to do all of the capital raising. So on the spectrum, if you look at kind of the progression of a typical real estate investor's journey, typically you're going to start off with your own capital, then you may move to JV where you partner with somebody, you guys do a deal together, or you move straight into syndication after you've gotten quite a few deals under your belt. And then after you've done some syndication deals, you transition into institutional capital. That's kind of a typical progression. Not everybody goes that route. Some people move into institutional a lot earlier. Some people stay with syndication through their entire career if they really have the system and the engine for raising capital. So it's a lot of different ways to do it. But institutional, as I mentioned, is typically after syndication because institutional requires very, very strong track record. That's actually one of the downsides is that they have very stringent requirements for track record. They want to see you do maybe 1,000 or thousands of units that are similar to the type of project that you're looking for capital for now. So they want to see a very extensive history to where most operators aren't at that scale. So the pros for institutional capital should be pretty obvious. One is fewer people to talk to. Now, of course, you may have to talk to different institutional firms to end up building the right relationships of who could fund your deal. But once you do, that firm may give you 90% of your equity. Now, a lot of times you may want to co-invest as a GP that other 10%, or you can also syndicate that 10% and raise that 10% from other retail investors. So you can kind of mix both between institutional and syndication. But institutional firms will typically give you 90% of your equity. So that means there's a lot fewer people that you actually have to raise from. It means it's fewer conversations, it's fewer investors to manage, it's fewer people that you gotta keep up to date on what's going on in the project. So that's one of the big pros. And with that, another big pro is that there's not going to be as much marketing involved. So, like I mentioned with retail syndication, there's a lot of marketing in the form of content, newsletters, a lot of investor meetings. With institutional capital, you don't have to do nearly as much and you don't have to do any hand holding. Investors at the institutional level, they're professional. They already know what they're doing. They've seen thousands of deals. They understand the market just as well, sometimes maybe even more than you do. So you're not having to teach people as much on what's going on, what the investments gonna look like, what it means to invest in real estate. You're not gonna do as much hand holding. They're already professionals. Another benefit is that you have some very niche firms that you can tap into. So depending on what your strategy is or what your investment thesis is and how you operate, you may be able to find a private equity firm or family office that really wants to invest in what you're doing. Say you're doing affordable housing or some type of impact investment. There's going to be some institutional firms that's what they focus on. Some of them may even look for a lower return or a slightly lower return, maybe something a little less than market if it's an impact investment because they're looking to do good by the community as opposed to just making as much profit as possible. So once you get to an institutional level, being able to tap into those firms can be a very great way to build a relationship and get your specific project funded. All right, so the cons of institutional capital. So as I mentioned, the requirements for track record are much higher when you're looking at the institutional side. I've seen some very, very strong developers with a lot of experience get turned down because they just didn't have enough experience for what the institutional firm wanted. So that's something to keep in mind. You got to really have a strong track record when you're looking at institutional capital. One way to get around that if you don't necessarily have as much track record is to partner, get a co-developer that does. Sometimes it only takes one or two deals with a strong co-developer with that institutional firm to really strengthen that relationship to where then you now have the autonomy to be able to go out on your own and secure institutional capital. Another con is that you're not diversifying your risk when it comes to your equity pulling out. If you're getting 90% of your equity from one group, if that group pulls out during due diligence and says they're not going to fund your deal, you really got an issue, especially if you have some kind of earnest money put up. So you always run that risk of, say, your institutional investor pulls out. Now you're dealing with a huge equity gap. You can't do the deal. A way to mitigate that is to have multiple relationships with other equity firms and be able to get some maybe soft commitments from a few different groups to where you have some backups. but that's still a huge risk because you're banking on one group to fund the majority of your equity. Another downside is going to be the return requirements. So as I mentioned before, institutional firms, institutional equity is going to look for higher returns than retail investors. And that's because they are essentially the middleman. So there's a cost associated with having another group, the institutional firm that's going to do all of the work of raising capital. Like that's all they do. They have to get compensated for their work. So essentially at the end, and they're going to give returns to the end investor, the people that they raise capital from. They want to give a return similar to what you would give if you were doing retail syndication. So typical, maybe 15%, 60% IRR that you would try to give your limited partners if you're doing a syndication. That private equity firm may be trying to give that same return, but they also need to be compensated. So for that reason, they may look for, and this is going to be standard, they may look for high teens, low 20s in terms of IRR. They want to see IRRs of 19, 20%, sometimes up to 22, 23% from you at the project level, because once they take their cut out, they want to be able to deliver that 15 to 16% return to their investors. So because you're introducing a middleman where you go to LP equity or institutional capital, there's going to be a cost associated with that. So you just got to have much stronger deals to be able to go to institutional capital because it's got to make sense for everybody involved. Another downside is just going to be the competitive nature. When you're dealing with these firms that they raise capital and their job is to deploy capital, other investors and other operators, other developers, they know that. And they're looking for these firms because they want to be able to raise all of their fund, all of their equity from one group as opposed to having an entire business that does in raising capital and the whole side for marketing. So for that reason, it's just incredibly competitive. These firms are looking at sometimes thousands of deals. Like they're looking at a lot of different deals, a lot of different developers. So only the best, the very best of the best deals in the best of the best markets with the best of the best operators actually get funded. And in the past few years, since they raised interest rates, capital has been very tight. A lot of institutional investors, a lot of private equity, they got burned once interest rates went up, and a lot of people had bought deals that necessarily weren't good deals, but the way the market was going, they were just buying stuff because they thought it made sense. Once the market shifted, a lot of these institutional firms that had LP equity and had equity into these projects, a lot of them got burned. So they're very wary, and the purse strings are super tight in this market. So it's very tough and it's very competitive to be able to get a deal funded. Not to say you can't do it, but definitely something to think about just how competitive it is. And you want to make sure you have your ducks in a row when approaching these institutional firms. Lastly, when you're dealing with institutional capital, they tend to want to have a little more control than a typical retail investor syndication will have. So as I mentioned, passive investors, they don't do really have any control or any say so over the deal. Yes, you still have to answer to them, but you still have control over the deal as a general partner who's sponsoring and operating the deal. When you're dealing with LP equity from a private institution or from a private equity firm or institution that's funding 90% of your deal, they have a lot of equity invested into your project. And because of that, they want to have a little more control. So a lot of times you see this come into play if a deal is underperforming. I've seen cases where one investor or one operator got institutional capital, put all of the equity into their project. The project wasn't performing. That institutional firm made them get another property manager and another operator to help and brought them in, make sure that they got a percentage of GP, and then also put their property management in place. So the operator who was doing that deal didn't have a choice in the matter. He had to take on that new partner and that property management because the institutional firm made them. So there's sometimes you're going to see that they want to have some sort of control because they got so much equity. And it's not just them, they have a whole bunch of investors who have invested in them, invested their capital in them, and they've turned around and invested that capital into you and your project. So they want to make sure that they're covered. So they want to be able to step in case things are going left to make sure that the deal can get turned around. So you do lose a little bit of autonomy when you're going to get institutional capital. So keep that in mind. So when should you use retail syndication versus institutional capital? So it really depends on your situation. If you're relatively new, or if you got some deals done, but you don't quite have just a huge track record to be able to get deals done, then it may be better to stick with retail syndication to continue to build that portfolio and build that track record. Especially if you already had success in being able to raise capital from investors in the past, and you have some repeat investors that you can raise from pretty quickly. That's going to be something that you can keep going back to. It can work for you. Now, if you're wanting to scale and you really want to start getting into bigger deals, and you're seeing the syndication route and raising capital being a huge burden on you, or it's something you just really don't like doing or don't have the systems for, don't want to build the systems for, if you have the track record or if you have the partnerships and strong relationships to bring in a co-developer, then you may be able to look into institutional capital. Or if you just have the track record yourself, to look into institutional capital. So that's one thing. It's all about having a track record and being able to compete at that level, especially if you can find good deals that are going to net the returns you need to attract institutional capital. So there's no one size fits all. It really depends on you and your situation, but it's all about how well you can raise capital from the group, how much you can market versus what your track record is and what your network is to be able to partner with the right people to get institutional deals done. So hopefully you got some value out of this video. Please go ahead, like, subscribe, comment, let me know what else you want to hear about, hear me talk about. And if there's anything else, feel free to reach out to me on LinkedIn, Sita Dambuya, and we go from there.